Picture this. You spot a breakout but hesitate. Was it real or just a fake out? What if you could cut through the noise and trade breakouts with unshakable confidence? Hidden in every chart is a pattern most traders ignore: the break and retest strategy. Today, I'll show you how to harness it to lock in profits, whether you're trading stocks, crypto, or Forex. Stay until the end. I've packed this guide with real chart examples, pro tips, and a foolproof checklist. And hey, if you're new here, smash that subscribe button and ring the bell. Your support keeps us motivated to continue creating free, actionable content that can truly help you level up your trading game. So let's jump right in. Break and retest is one of the most reliable patterns in trading. Yet, strangely enough, most beginners often overlook it. Why? Many traders jump into breakouts too early, or they miss the retest entirely. Today, I'm going to show you step by step how to master this strategy. In our session, we'll cover several key topics. First, we'll define what a break and retest really is, hinting that it's not simply buying the dip. Next, we'll learn how to find key levels by using support and resistance, Fibonacci retracements, and even those hidden fair value gaps that many traders tend to miss. I'll then reveal the 3 non-negotiable criteria that can help you avoid fakeouts and trade with absolute confidence. And finally, we'll walk through some real chart examples, both bullish and bearish, so that you can see exactly how this strategy works in action. Get ready, because by the end of this video, you'll have a powerful new tool in your trading toolkit. Let's dive deeper. Imagine you're watching the market, and suddenly it breaks through a resistance level, almost like a rocket blasting through a cloud layer. But here's the secret. The true opportunity doesn't lie in that initial burst. Instead, it comes when the price comes back down to retest that very level. Think of it like a trampoline. The market makes a strong upward move, then it pulls back to that same level. If that level holds as support, it sends a clear message. This is our new starting point. That's your green light to enter the trade. Now, you might be wondering, how do I know if that level will hold? There's several price action signals to watch for. First, look for a bullish candle that closes strong after the retest. This indicates that buyers have stepped in. Next, observe if there's a cluster of small candles hesitating at that level before finally bouncing off. This hesitation is a sign that the market is testing its strength. And finally, pay attention to what traders call a fair value gap, a situation where a large candle leaves behind an imbalance. Markets often revisit these gaps to fill them. Each of these signals tells you that the market is committed to a new trend. Rather than chasing the breakout at the first sign of movement, waiting for that confirming retest can lead to more reliable trading decisions. Now that you understand the concept behind break and retest, let's talk about how to practically identify these key levels on your charts. Start by pulling up any chart of your favorite trading instrument. You'll notice that the price has highs and lows, those points where the market reversed direction. These historical turning points are your starting points for identifying support and resistance. But to really refine your strategy, you should layer in a few additional tools. Fibonacci retracements. Draw a Fibonacci retracement from the swing low to the breakout high. Many traders look to the 50% to 61.8% zone as a critical area. It's here that price often finds support or resistance, a zone that many call magical. Fair value gaps. Sometimes you'll see a large candle that seems to skip over a range of prices. These gaps occur because the market moved too quickly, leaving behind an area of imbalance. Traders believe that the market will eventually revisit these gaps. Trend lines. Another essential tool is drawing trend lines. If the price is consistently making higher highs or lower lows, these lines can confirm the overall trend direction. A pro tip: when you see multiple tools, say a Fibonacci level aligning with a fair value gap, converging on the same area, you have what traders call confluence. This confluence is a strong signal that the level is significant, and it's a cue to pay extra attention. By combining these tools, you create a reliable roadmap for your trades. This is what separates a casual trader from someone who can trade with precision and confidence. Even with the best strategy, many traders fail because they ignore a simple checklist. So here are the 3 non-negotiable rules you must never ignore when trading break and retest. Trade with the trend. First and foremost, always trade in the direction of the overall trend. If the market is bullish, wait for breakouts above established resistance levels. If it's bearish, look for breakdowns below support. Trading against the trend is a common pitfall that can lead to unnecessary losses. Momentum matters. The breakout candle itself should be strong, stronger than the candles leading up to it. You don't want to see a tiny candle with long wicks. You need a solid, decisive move that tells you, this move means business. This momentum is crucial for confirming that the breakout is genuine. Wait for the retest. Finally, and perhaps most importantly, patience is key. Only enter a trade when the price comes back and retests the breakout level. This confirmation is essential. If the price fails to hold the level during the retest, it might be a false breakout. In trading, it's always better to wait for confirmation than to rush into a trade prematurely. By sticking to these 3 rules, you protect yourself from many common pitfalls and set yourself up for success. This checklist is your safety net against the inevitable noise of the markets. Now, let's put theory into practice with 2 real-world examples. Example 1. Consider this chart. For a while, it was trading in a tight range, with price bouncing between clear support and resistance levels. Then, suddenly, it broke out with a massive bullish candle. But the real magic happened next. The price retested the old resistance level, which now acted as support. This retest aligned perfectly with the 50% Fibonacci retracement level and a visible fair value gap. As the price held, traders saw a clear bounce, and the trade resulted in an impressive 3-to-1 profit ratio. Example 2. Now, let's look at a bearish setup. In this scenario, the price broke below a key support level with a huge red candle, a clear sign of selling pressure. Instead of immediately entering a trade, the smart move was to wait for a retest. When the price returned to the broken support, it aligned with the 61.8% Fibonacci retracement level. Adding to the bearish sentiment, a classic engulfing candle formed at the retest. This combination of signals provided the perfect setup for a short trade, leading traders right into what we call Profit City. These examples show how the break and retest strategy works in both bullish and bearish scenarios. They also illustrate how critical it is to combine technical tools and wait for confirmation. In both cases, patience and attention to key levels made all the difference. So there you have it. Break and retest isn't just another trading strategy, it's a mindset. By embracing patience, confirmation, and trend alignment, you can transform your trading approach and avoid the pitfalls that catch so many traders off guard. Before you head off to apply these techniques on your own charts, I want to leave you with a few final thoughts. If you found this video helpful, please give it a like. Every like helps us reach more traders looking for practical, actionable advice. Don't forget to subscribe to our channel for more strategies that turn complexity into clarity. We're committed to providing you with the tools you need to succeed. And I'd love to hear your thoughts. Comment below with break and retest if you're ready to try this strategy, or drop any questions you have. Your feedback is invaluable.